Welcome to Property Report UK, the channel where we break down the stories shaping the future of Britain's housing market. Whether you're a homeowner, a potential buyer, a property investor, or simply someone keeping a close eye on the wider economy, this is the place where we cut through the noise and explain what the latest developments really mean. Here, we look beyond the headlines. Because the housing market is never just about property prices, it's about interest rates, inflation, government policy, and global events that can ripple through the financial system and ultimately affect what people pay for their homes. Today's update brings a mixture of optimism and caution for the UK property market. Fresh figures suggest house prices are continuing to rise, showing resilience after a difficult period for homeowners and buyers alike. But at the same time, mortgage rates are beginning to edge upward again, and that could change the trajectory of the market in the months ahead. Behind those changes lies a much bigger story involving global tensions, energy prices, inflation expectations, and the future direction of interest rates in Britain. So let's take a closer look at what's happening and what it could mean for homeowners, buyers, and the housing market overall. New data released by Halifax shows that British house prices increased in February at the fastest annual pace seen since last autumn. According to the lender's latest housing index, the average price of a home was around 1.3% higher than it was at the same point a year earlier. That figure came in slightly above the expectations of many economists, who had predicted a smaller annual increase. It also represents a modest acceleration compared with January, when annual price growth was measured at around 1.1%. While these numbers do not point to a dramatic surge in property values, they do suggest something important: the housing market has continued to show surprising resilience. After the turbulence of the past few years marked by rising interest rates, higher living costs, and economic uncertainty, many analysts had expected house prices to remain flat or even decline further. Instead, the market appears to be stabilizing. Looking at the monthly figures gives us a little more detail about that trend. House prices increased by about 0.3% in February compared with the previous month. That's broadly in line with expectations, although it is slower than January's 0.8% monthly increase. Even so, the fact that prices are still edging upward suggests there is still underlying demand in the housing market. For many analysts, this steady growth reflects a gradual adjustment taking place after the sharp rise in borrowing costs during 2023 and 2024. Buyers have begun to adapt to a new environment where mortgage rates are higher than they were during the ultra-low interest rate era of the previous decade. However, just as the housing market was beginning to find its footing, a new complication has emerged: mortgage rates themselves may be starting to move higher again. According to figures compiled by the financial data provider Moneyfacts, the average two-year fixed residential mortgage rate has now climbed to around 4.84%. On the surface, that may not appear to be a dramatic increase. But what matters is the direction of travel. For several months, mortgage rates have been gradually drifting downward as financial markets began to anticipate that the Bank of England would soon start cutting interest rates. Many lenders had already begun adjusting their mortgage offers in anticipation of those future rate reductions. In other words, cheaper borrowing costs were being priced into the market before the central bank had even made its first move. But events outside the UK are now beginning to challenge those expectations. Financial markets have been reacting strongly to escalating tensions in the Middle East. As geopolitical uncertainty increases, energy prices, particularly oil and natural gas, tend to rise. And when energy prices rise sharply, it can feed directly into inflation. Higher energy costs push up the price of goods and services across the economy, which in turn makes it harder for central banks to bring inflation under control. For policymakers at the Bank of England, that creates a difficult balancing act. On one hand, they want to support economic growth and ease pressure on households by lowering interest rates. On the other hand, if inflation risks start rising again, cutting rates too quickly could make the problem worse. This uncertainty is already visible in financial markets. One of the key indicators used by lenders to determine mortgage pricing, known as swap rates, has surged significantly in recent days. Swap rates effectively represent the cost of borrowing money in financial markets over a fixed period. Banks rely on them when setting mortgage rates for customers. Over the past week, 2-year swap rates have jumped by as much as 0.42 percentage points, a large movement in a relatively short period of time. When swap rates rise, lenders often respond by increasing mortgage rates to protect their margins. That's exactly what appears to be happening now. Amanda Bryden, head of mortgages at Halifax, says geopolitical uncertainty could play a major role in shaping the economic outlook in the months ahead. Conflicts abroad can send shockwaves through energy markets, affect inflation expectations, and ultimately influence how central banks set interest rates. Only a few weeks ago, the broader economic picture had looked more encouraging. Inflation in Britain had been falling steadily, reaching its lowest level in roughly a year at the start of 2026. Forecasts from the Bank of England suggested that inflation might move closer to the official 2% target by the spring. If that trend had continued uninterrupted, it would likely have cleared the way for interest rate cuts later this year. But rising energy prices have now complicated that outlook. Economists say markets are beginning to reassess how quickly borrowing costs will fall. Matt Swannell, chief economic advisor at the EY Item Club, believes the recent surge in oil and gas prices has forced investors to rethink their expectations for interest rate reductions. In simple terms, if inflation risks rise again, policymakers may decide to keep interest rates higher for longer than previously expected. And that matters enormously for the housing market. Mortgage affordability remains one of the biggest constraints facing buyers today. Higher interest rates mean higher monthly payments, which can dramatically affect how much people are able to borrow. First-time buyers are particularly vulnerable to these shifts. Many are already struggling with high house prices, rising rents, and the challenge of saving for a deposit. Even a small increase in mortgage rates can significantly reduce purchasing power. There are already signs that some buyers may be hesitating. Recent figures from the Bank of England showed that mortgage approvals for house purchases unexpectedly fell in January. In fact, the number dropped to the lowest level seen in roughly 2 years. That decline suggests some households may be taking a wait-and-see approach, delaying purchases until there is more clarity about where interest rates are heading. Despite those challenges, one factor continues to support house prices: the persistent shortage of homes. The UK has long struggled with an imbalance between housing supply and demand. In many parts of the country, there simply aren't enough properties available for sale. When supply remains limited, prices often stay supported even during periods of economic uncertainty. Addressing this shortage has become a major political priority. The government led by Keir Starmer has repeatedly emphasized the need to accelerate housebuilding in order to tackle Britain's long-standing housing crisis. Increasing the supply of homes is widely viewed as one of the most effective ways to stabilize the property market and improve affordability over the long term. However, building new homes is a slow and complex process. Planning approvals, infrastructure development, construction timelines, and labor shortages can all delay progress. As a result, the shortage of housing stock is likely to remain a defining feature of the UK property market for some time. Another set of data released earlier this week reinforces the broader picture. Figures from Nationwide Building Society also showed house prices rising in February, with a monthly increase of around 0.3%. According to Nationwide's index, annual house price growth now stands at roughly 1%, a modest but steady pace. Taken together, the latest reports from the country's largest mortgage lenders paint a consistent picture. The housing market is not booming, but it is holding up better than many had expected. Prices are gradually rising, demand has not collapsed, and the market appears to be stabilizing after a difficult period. At the same time, the outlook remains highly sensitive to wider economic forces. The direction of mortgage rates, the path of inflation, and developments in global energy markets could all influence what happens next. For homeowners and buyers alike, the coming months may prove crucial. If inflation continues to fall and interest rates eventually begin to decline, borrowing costs could ease, potentially providing fresh momentum for the housing market. But if global tensions keep energy prices elevated and inflation pressures return, the Bank of England may have little choice but to keep rates higher for longer. And in a market where affordability is already stretched, even small shifts in borrowing costs can have a major impact. That's why understanding the bigger economic picture is so important when looking at the future of property prices. And here on Property Report UK, we'll continue tracking every major development from house price trends and mortgage rates to government policy and economic shifts, so you can stay informed about where the market may be heading next. If you found this update helpful, make sure to subscribe to Property Report UK, give the video a like, and share it with anyone interested in the future of the UK housing market. We bring you clear, independent analysis of the policies, financial trends, and economic forces shaping property across Britain. Thanks for watching, and we'll see you in the next update here on Property Report UK.